Welcome to today's video on quantitative easing, or QE for short. Today we'll explore what it is, how it works, and its effects on the economy. Quantitative easing is a monetary policy used by central banks to inject money into the economy, particularly during recessions. This is accomplished by the central bank purchasing securities and other assets from the market. While central banks regularly engage in asset purchases, the scale and the types of assets involved during QE programs are significantly different. Before I go into a lot of the specifics of QE and how it works and stuff like that, I want to quickly talk about the central bank and its goals because that gives context to why QE programs are taken on by the central bank. Central banks primarily aim to manage employment rates and stabilize prices. These goals help the central bank manage the economy. In times of recession, they implement expansionary monetary policies that encourage spending which stimulates the economy. One key strategy is lowering policy interest rates. When these rates decrease, other interest rates, like those for car loans and mortgages, follow suit and reduce the borrowing costs and boost consumer spending. So, how does QE stimulate the economy? When the central bank buys assets, it replaces those assets with cash, thereby increasing the money supply in markets. This process expands the central bank's balance sheet. The goal is to lower borrowing costs, especially when markets are tight and banks are reluctant to lend. Lower overnight rates allow banks to borrow money cheaply, but they may still have high interest rates on long term loans. By increasing the money supply available to banks, the hope is that they will offer more loans as the cash they hold earns very little interest. This competition among banks to lend more money can lead to lower interest rates overall, making borrowing cheaper for consumers and businesses. Now let's talk about QE's impacts on yields. A yield represents the income generated by an asset relative to its price. When the central bank buys assets, they drive up asset prices, which in turn lowers yield. For example, if the government issues $5,000 treasury bills paying $100 annually, the yield comes out to be 2%. If the central bank bids up the price of those bills to $5,500, the yield drops to 1.8%. Since the bills have a higher price, the government can now drop their interest payments to $95, for example, and still stay competitive because the yield is 1.9%, which is greater than the 1.8% that the outstanding bills have. Because the government is paying a lower yield, this allows them to spend more and borrow more money to stimulate the economy. So, as the government debt yields decrease, investors often seek higher returns in riskier assets. This shift encourages investment in various sectors benefiting capital markets, such as the stock market. As I stated before, central banks engage in asset purchases regularly. QE stands out due to its scale and the variety of assets involved. For example, during the financial crisis of 2008, the Federal Reserve purchased over $1 trillion in mortgage backed securities from 2009 to 2010. However, QE is not without its downsides. One significant concern is the potential for inflation. An increased money supply can devalue the currency, leading to rising prices. Moreover, simply injecting money into banks and businesses doesn't guarantee it will be lent or spent by the bank and business. During times of low confidence in the economy, banks and businesses may choose to hoard the cash instead. Additionally, the timing of ending QE programs is very crucial. Ending a program too early or too late can create more significant economic problems than those that existed before the QE program began. Thank you for joining me to explore quantitative easing. I hope this overview has enhanced your understanding of the topic, and if you found this information helpful, please like and subscribe for more insights on finance and economics related topics. Thank you for watching.